Major support for these broadcasts is provided by Perfect Building Maintenance, New York Community Bank, Chase Commercial Term Lending, Chelsea Lighting, Capital One Bank, Genova Burns, Giantomasi and Webster, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by Ackman Ziff Real Estate Group, Bank of America, Merrill Lynch, Briarwood Organization, Bruce Mosler, Cassidy Turley, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Flushing Bank, Gemini Real Estate Advisors, LLC, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wyckoff Group, Urban American, and These Friends.
And the leasing market is questionable. I mean, there's an election, there's other things, the stock market's up and down, T-bills have increased by 40 basis points. So, how do we see the office market moving these days? So I've brought together today an interesting group. I've brought together a banker who's also looking for space, two prominent brokers, and an owner to provide their insight on how they see the state of the office market. My guests, they include Gino Martocci, who's the president for New York City and Long Island for M&T Bank, Mark Boissy, who is the chairman for the tri-state region of Cassidy Turley, Joe Harbert, who is the president for the tri-state region, eastern region for Collier's International. Okay. And last but not least, Winston Fisher. At least we have some owner over here, and a major owner, a principal at Fisher Brothers. So since you have to deal with these people, I mean, and they're nice people, with the exception of Boissy, who has been playing too much golf because the son.
People. Wow.
Oh,
it's a good start to this show.
No.
Friends,
no.
Michael, you called me a broker.
I call you a broker, but that's because you're all friends of mine, so I can joke about this.
You lost control of the show already.
Okay, I didn't lose that. So here's the question: how do you, as an owner, see the summer, and how do you see the beginning of the year, and how do you see the balance of the year in the office market?
And the office market today is quiet. It's slow. I mean, the area, Midtown you're seeing financial service firms are quiet. Professional services are quiet. There's the uncertainty. I mean, as I think that we're probably all going to say, it's the uncertainty of the debt crisis, the fiscal cliff, the elections, Europe, and it's just created a stagnation. Going forward, how do things get resolved? I think that they're going to be resolved positively. Probably some pain, but it's not going to be catastrophic.
But we have a double thing going forward. We have the major presidential election this year, and next year we have a mayoral. So sometimes you can say we have the presidential election and it's over, but we have a major change because we really, Mike Bloomberg has been a good businessman, has been an excellent mayor, and now you have a situation that you have some very good candidates, and as you know, I don't talk any political thing on my show, but we have uncertainty, which will maybe make this take a little longer. You've had a good year in many, the Avon deal and some other Random House, your organization, and Cody on the situation of the Empire State Building. with the, how many people, and we've said this before, there are a lot of lease renewals. People are renewing. How many people?
There's been huge lease renewals in the last
I mean,
couple of months.
Viacom, 1.6 million,
Viacom.
Morgan Stanley, 1.2 million square feet.
Citibank, most recently, and that's been a lot of our activity. In terms of new transactions for growth of space, those aren't happening. And especially in Midtown, Midtown has really suffered because the financial service sector has really come to a halt in some respects in terms of their growth expectations and their uncertainties. I tell you what, if I was a tenant, I'd love to be a tenant in this marketplace. There are opportunities in Midtown that you can avail yourself of. I wouldn't say that about some other markets in the city, Midtown South.
So let's talk about Joe and Mark, since you guys see that pace exactly in the Midtown. What are the opportunities for a tenant today in Midtown? What type of deals can they get?
I think the prices are really very low. If you go back to the high point of our market several years back, we are way, way down compared to where we were. We're not looking at $92 average rents. We're looking at 60s and 70s with $60 in work, and concessions are creeping back up the last 2 or 3 months. If you've been a tenant out there and you've been looking for 4 or 5, 6 months, owners are sitting down saying, the market's a little slower, I'm going to close out that deal. Let's get those guys in a room and let's close it out. And you're getting a couple more dollars, a couple more months.
I mean, I see the market as sort of taking a little bit of a breather now. We came back from some really awful, awful times in 2009 and 2010. We recovered pretty dramatically from that. Maybe we recovered maybe 70, 75% of sort of pricing. So we're taking a breather because of the uncertainty of the economics and government, et cetera. But so tenants today, I mean, JP Morgan has put space on the market. Societe Generale, who just did a big lease on Park Avenue, has put space on the market. McGraw-Hill has just put 200,000 feet on the market. I mean, Nomura, who moved from downtown, from 900,000 feet downtown to Midtown, has put 200,000 feet of the 900,000 feet they just took Midtown on the marketplace. So the opportunities I see are really in the sublease market.
Now, I remember maybe a year ago we were talking, you were on the show, and we were talking about some top-notch Park Avenue buildings, not as good as 299 Park, especially since we have the owner of 299
or
Park.
Park Avenue Plaza.
Oh, Park Avenue Plaza.
Come on, let's
No, so we have that. But we were talking some buildings, as we would say, in the JP Morgan campus over there, that you were talking that on a sublease, you were able to get rents at like $75, $80.
Less now.
Less.
Yeah. Well, yes, they have space on and JP Morgan has gone through a significant sublease program at 277 Park, and they've sublet maybe 500,000 feet of their 1.3 million feet there over the last 3 or 4 years, and a lot of it during the very, horrible financial crisis we went through. They have a few floors left over, and there's a mandate to unload them. So there's some opportunity there, and I don't know, you've probably seen a lot of different
Now,
spaces.
Gino, you have a double side today, okay? You have a side as a company who, you took over Wilmington Trust, you want to consolidate your operation all under one roof, and you were looking for space, and you also look at it because you're a guy who lends to people who are buying buildings. So let's ask you the question on 2 ways. Tenant. Let's talk about, you've been looking, I know, for at least the last year, you've been negotiating. How has the market changed with regard to you looking and consolidating space and different opportunities? And then we're going to ask you with regard to the banking position of how you look at buildings and situations.
Well, if you go back to late last year or the spring, I think, and certainly even a year ago, before the summer last year, so January, February, March, April of 2011, and then again in the spring of 2012, I think the landlords are feeling very good about their space. I'm speaking as a tenant now. And they were probably less willing to negotiate too much on asking rents, and the packages that they were providing were probably somewhere, in my opinion, 20–25% different from where we're sort of ending up.
So you're seeing a 20 to 25% difference in the pricing structure as you were, as opposed to last year?
No, in TI and the packages they're providing outside of face rent. Face rent still is depending on the building that you're in and where in the building you are. Base building is different than the upper floor spaces. They're trying to hold their face rents as much as they can. the sublet space is where the opportunity is, and that's what's changed, and that's what's pressured the landlords on the direct rents. From what I've seen. Is that fair? I mean,
yeah, I mean, we're seeing it in our buildings. We have a lot of tenants who are, well, not a lot. We have a few tenants who are looking to sublease. As a landlord, that's actually opportunity for us because if they have 6 years left on their lease, they're willing to take a hit up front. We can then find a great tenant. They're going to front load all the costs. They'll pay the high TIs, and then we can actually bump up the rent to what we think will be a market rate, and we have no out of pocket. Our net effective is pretty good, so it's actually good for all parties concerned because we don't have, But you're seeing it out there. There's a lot of space on the market. I mean, the sublease space.
But
it's still only 17% of the availability.
And
it hasn't changed dramatically.
And it's
but it's enough. It's been enough to pressure the landlords on the direct rents.
Well, you feel the pressure?
We don't have space.
Then you have
so I mean, that's. I have to tell you though, would you want to have a big block of space today? No. I think that you would.
And it's a midtown phenomenon.
That's right.
It's
a
Class A phenomenon.
Exactly.
Midtown Class A.
If you looked at the amount of 100,000 square foot blocks of space there were like last year, I think it was like 35 or something like that. This year, it's like 45 or 50. So, and that's
last year
to a large
hot
degree
leasing
because
year.
of.
You got to remember that with 38 million square feet leased last year, it's a much different year.
Yeah.
It's more of an average year. It's a 24, 25, 26 million square foot year.
Listen, we own a building on 3rd Avenue. I think it's probably the best value in New York City. I mean, it's like 605 3rd Avenue, and we have a little space coming up. The rent.
You have 60,000 feet for me?
We could find it though.
You can broker the deal, Michael.
Could be the first show when you really broker a deal.
And that market's as quiet as can be. Park Avenue, 6th Avenue, there's activity, but it's at depressed rents today.
It's retraction of the law firms and the financial services industry. That's really
law firms
what it
are
comes
very
down.
quiet this year.
Law firms.
And
very quiet.
Now Midtown South, as we've talked about before, it's booming.
Yeah.
And I think it shows the vibrancy of New York and really the future of New York. There will always be a strong financial services industry in New York. But without.
That's financial
has
services.
to be the case.
What about
but you
legal?
also
What
have
about
the
professional
technology.
services? We talk that professional services, legal services are a little quiet. Accounting firms are, there's more hoteling, there's other situations. And, let's be realistic. Law firms are consolidating smaller space, better efficiency, more one secretary to handle more partners. I mean, that's happening over there. So there's an efficiency level, right?
Workplace strategy dictates these days that you try to shrink the square footage per person, and it's pretty dramatic for some firms.
Everybody's doing it.
Everybody's doing it.
I mean, you're going from, I think we had 320 or 340 per square foot per person. We're sort of building to, we're taking more space, but we're building to 250, 260.
Yeah.
I mean, which is more than some, but
Yeah. But New York's not going. I mean, let's
No.
not.
I don't believe. Look, this is we don't have.
It's a healthy market.
We don't have a crisis.
market,
We don't have a
right.
crisis in New York City on the
9%
market
vacancy.
whatsoever.
The vacancy rate is still pretty low, and when employment picks up, watch out.
Watch out. Exactly.
Watch out, because the prices are
Wait,
going to
wait. When employment picks up, let's.
2015, I wouldn't want to be in the market.
No, that's
As
what
a
I want to do
tenant,
with
as a
Bill
tenant.
Fisher
As a
today.
tenant, no, it's listen.
It's
if
true.
Anybody
Wait a second.
who said it-
2015. Don't I have space in the World Financial Center, World Trade
downtown.
Center downtown?
Somebody said those
I
are
mean,
different
but
markets. You said it yourself. Those are
Also,
very
how
different
big is
markets.
it? I mean, let's not kid ourselves. I mean, you're talking 5 million square feet. It's not the end of the world.
Wait a
when we're
second,
talking
but don't
about-
I have Hudson Yards? Don't I have other properties? No, I have a variety of space. I'm not even talking about the outer boroughs. I'm talking about there's Hudson Yards, there's Gary Barnett's property, there's Boston properties on 55th Street, there's some buildings coming on bound, okay? There's
Comparatively
absorption.
speaking to other decades, our construction has been, de minimis.
No, I'm not,
I mean,
Mark, I'm
so-
not disagreeing, but
So in terms of new buildings, that's really not putting the pressure on the market in Midtown.
I'm not worried.
And downtown, it's, they've been really good in terms of what's happening downtown. And Silverstein, I think, and the Port Authority have done a good job in not building number 2
Yeah, which
and
one?
number 3. Building just that one tower and then doing the platform and waiting for a tenant for the next building to go up. So, when you look at that, there's only about 2 million feet that they have to lease, the balance of One World Trade Center and then number 4. And then you've got
so
World
who's going
Financial.
The World Financial,
So
which
who's
is-
going to take the Condé Nast space in Midtown that the Port Authority is taking right now? I mean, you
That's
have
going to be
you-
a 2015 situation.
But isn't that a large amount of space?
Yes,
Condé
it is.
Nast? You have a Condé Nast
Yeah, it
space
is.
over there
It
that's
is.
going to
It
become
is.
available. You know, it's
But if the economy picks up, I mean, if we're in the doldrums for another 3-4 years, we should have that discussion about how nervous we are. But if you have, I mean, I'm hearing, and I know I feel somewhat positive about the outlook of New York and the outlook of really America, right? The United States is not, you know, the oceans aren't rising up. It's a good place to do business.
Okay.
And
You know,
we're going to get out of this place, and employment will
Here's
pick
the
up.
problem that sometimes I have with the show, which I'm finding out. New York is 5 boroughs. And, you know, the real estate board, when they do their residential report, they only even talk about 4 boroughs. They don't even talk about Staten Island. You know, I look at the Rebney report. But there are other boroughs. Now, I believe that Brooklyn is doing better because there hasn't been any new space built in Brooklyn for at least 10 or 15 years, so it's fine. Queens, with the exception of the building that was built, you know, Gotham Center, which was basically built for the government services, there isn't over there. How do you, and I think
Court Square traded at a big number.
Court Square, because it was a lease. How do, and both of you handle the tri-state region. How are the rest of the markets? How's New Jersey and how's Westchester doing?
Well, I'll do Westchester and Fairfield. Bridgewater's just signed for 750,000 square feet to build a building up in Stamford. And now they're in Westport, but it's a lot more space than they have now. We were just fortunate enough to close a deal for 875,000 feet for PSE&G in New Jersey.
Renewal.
Well, 50% of the market's renewal. It's a lease and it's a commitment, and it's going to be good for Newark. So I think New Jersey is a little bit slow. I don't think that it's recovered really from any of the preceding 3 recessions. And so there are issues and problems out there. You're not finding any movement out of New York at the present time into central New Jersey or any of those areas, except for maybe a data center.
And you, Mark?
No, I happen to agree with you. I mean, the vacancy there is, hovering in the 20% range, both there and in Westchester.
Yeah, but here brings up an interesting point, and I think it's something that Gino will bring up also. A lot of the space that's been leased in New Jersey, especially Newark, you know, with Panasonic and with Prudential, is due to urban tax credits. The accounting firm of Eisner Amper is moving into Woodbridge, which is their market over there, and it's tax credits. It's over there. We don't have tax credits that we're offering to people today. We always win and lose tenants, you know, we're always in that situation. It's 2015. We hope the economy's fine. We have space at Lower Manhattan on B and C buildings over here. Who's going to take that space, and do we need tax credits to get that? Do we have to go back to 421Gs? You know,
A lot of the growth has come from technology companies, and they're not going into the World Financial Center for the most part. They're going to go into the B buildings. I don't know about the C buildings.
but they like, as we said, Midtown South before. Technology.
Being priced out of
being
Midtown
priced out,
South.
yeah.
Those
That'll
tenants
spill
are
over.
coming north and going south.
That'll
Exactly
spill
right.
over. I mean, is the question, do I wish that New York City had a coordinated effort to attract tenants the way New Jersey does?
Yes.
Yes. Would that be good for the market? Yes. I mean, they should do it. I don't know if that's
I mean,
local
let's be
or
realistic.
state level.
Starwood last year,
nice.
Starwood moved out of Westchester and they moved to Connecticut. The incentives were enormous. I mean, that's what they
But
bought.
we should do it.
But New York has a very healthy market, comparatively speaking, so they don't really have to reach for these tenants. And I think Mayor Bloomberg has sort of proven that out over the last several years. He's not offering huge packages to people to stay.
Now, what about we've had some good investment sales this year, but it's slowed down, I'd say, in the second quarter and right now for office buildings. M&T is an active player, a very active player. I know you financed the property that Kaufman and Invesco bought a couple years ago on Fifth Avenue, which is really doing well, and you've done some other.
Almost 100%
Okay.
occupied now.
How are you looking at, as a lender today, when people are buying buildings?
Well, we're looking at it really 2 ways. We're going in sort of debt yield, and then whatever their plan is for lease up, and then 5 years from now or 7 years from now, what the debt yield's going to look like prospectively, so that we can account for a rise in interest rates and any sort of sensitivity in asking rents or effective rents.
Right.
So we'd want to go in. We'll go in as low as 6 or 7 if there's a plan to get up and there's some vacancy. But we want to get out at 10.5 or 11 or higher, because you've got to account for a rise in rates over that period of time, and who knows what happens to the rents exactly.
I mean,
I suspect they're going to be higher.
But we have
go up.
we have an artificial
Question how much.
situation. We have interest rates at such low rates
Exactly.
today. And these rates are, I mean, we've never had, I remember I did a show a couple of months ago and I asked Philip Eisenberg about rates in the residential. He said, I never saw it. He said his father, who was in the business in the 40s, probably never saw rates this low.
If you underwrite to a 10, if you underwrite to a 10 debt yield, that equates to basically a 7% rate plus 30-year AM. So could it be higher than 7% 5 years from now? Could be. Maybe. But
you know, I still remember
and
Mike
130 coverage.
I remember Mike Fascitelli being on the show, and he said, you know, I knew when we should stop buying buildings in the property when a young analyst came into my office, and David Greenbaum, and he said, in 3 years our rents are going to be at $225. He says, I know that the world has changed. I mean, and let's remember, we were talking a couple years ago, 2007, hey, whatever number you want, buildings, it's better if the building's vacant, everything like that. You know?
That's what got us into trouble.
That's
That's I mean, come on. Anybody who thinks a vacant building's better than a
No,
whole building
wait a
shouldn't
second.
be in real estate.
2007, a lot of people
Winston,
did.
Unfortunately, in 2007, there were a
My
variety of
Uncle Zach
situations.
always said, it's not beautiful unless it's rented.
That's why you're still in business.
That's why you're in
That's
business.
the fundamental. Yeah.
Now, but what are you seeing with regard to the new people who are buying buildings, the funds or certain other people? Are they astute enough to be in this market over here today?
My perspective is if they're willing to put in 45% equity and they've got a plan that makes sense and they've got some experience, they're astute enough. I mean, we're willing to take that risk at 55 or 60%. And I think a lot of these guys have been through, they went through the last cycle. So they saw that there's mistakes that were made. They're not performing rents at, 10 and 15 and 20% year increases and ongoing forever. So I would say for the most part, yes. And you've always got to pick your borrowers.
So here's an interesting question. I think 2012 should be the year of, it's like in baseball. It's trading. People move to different locations. Different teams. It looks like the baseball teams of the brokerage business. The world has changed over here. From Canada we have Avison and Young. From California, we have Lee and Associates. I mean, all these new firms,
And new franchises.
New franchises, okay, bonus babies. How do you see the brokerage business, which is changing quite a bit?
Well, I take it as an indicator that the market might be a little bit slow insofar as I get calls from brokers all the time. But I'm in the broker business, so I like getting those calls. There's the perception that there's more movement than there really is.
Is there room, okay? People would say they used to be the AB, they were the top three firms, the top international national firms. Now there are a number of other places. There's the Grubb Newmark Grubb Knight Frank. Your change over there, the Cassidy Turley, the Colliers International is a different change. The Lee and Associates, the Avison, and all the rest, and maybe there'll be Crespa Partners and all these Crespa Partners. Right. Do you see more of these? Do you see more new brokerage firms, though?
Barrier to entry is pretty high here, but I think what is happening is that some of the larger firms have gotten too large. That's my impression, and we're the beneficiary of that. We're both with
an opportunity
kind of
for the
boutique firms in New York connected to large entities. It's a great strategy for us.
Exactly.
So. You as a banker, how do you look at it? As a banker, with regard to being in the banking business, to lend to brokerage firms or other things?
We don't. They're not typically big borrowers. I mean, at all. So we don't do that.
And as an owner, how do you look at with regard to the new brokerage firms?
I mean, we're happy to work with anybody to the extent. I mean,
Bring me a tenant.
Yeah, bring
I'll
me a
work
tenant.
with you.
It's exactly right. I mean, we have obviously our policies don't change. We're gonna, pay quickly, pay promptly, pay fair to the broker who brings us.
That's
a
why
tenant.
you've been in business close to 100 years. I mean, that's not the question. That's why I brought
No,
you.
but yeah, how do we we don't discriminate.
No.
Well, it's the same group of brokers you dealt with before. They just had carrying different cards.
Yeah, I mean, we know them. They're our friends. It's.
Now, we spoke about Midtown. We've spoken slightly about downtown. Is Midtown South really that strong these days?
Yes.
It's the strongest market in the country.
And what do you know, I remember when Paul Paris was on my show when I went from radio to TV. It was one of my first shows in 2003, and we were talking about 111 8th Avenue. And when he went to the New York State Teachers Retirement to invest, they said, are we crazy? We're going to invest in this crappy Sylvan Lawrence property over there at 111? I mean, look, what's made Midtown South different today? Joe?
It's just the character of the buildings, the neighborhoods. They're cool places. People want to be there. I think the young people are driving a lot of this in the city. People really want to be in Midtown South.
People want to work where they live. And when you think of new media and technology and all the employment that's happening in that arena and the youth factor, they're all downtown. They're all in
I don't want-
Chelsea. They're all
Murray
in
Hill.
Flatiron. They're all.
What's driving
I mean,
it is exactly that. It's new media. It's New York City has, and I give Bloomberg a lot of credit, has done a great job of making New York City a place for social media tech, that it's a real incubator city today. I mean, everybody, we're the second largest recipient of VC capital outside of Silicon Valley. Silicon Alley is strong. So why is it young? The buildings are cool. They're hip. They've got character. They can live,
Neighborhoods are
work.
great.
eat.
And the restaurants
There's
are cool.
hotels.
They're right,
Yeah,
then
I
they're
mean,
right
think of the
downstairs.
there's a
transportation.
vibe.
Yes.
People want to live here. The young people want to move here and want to live here, and that's what we got to maintain.
There's a great vibe.
I don't want to wear my pessimist hat, but since I'm known as that. Anyway, okay, 2000, I still remember I was doing some consulting in March of 2001 for Deloitte & Touche, and I was working with all these young techies, and then all of a sudden one day we laid them off. The world changed. You know, look, Zynga's not doing that well today. You know, Facebook is doing well, but there are a lot of these companies. You know, maybe this tech revolution and all the rest changes.
Could be a bit of a bubble. Could be.
That's what I'm. You
The
know,
tech is here to stay.
I
mean,
Winston, I agree.
that's-
Tech is here to stay, but you know what?
Apps aren't going anywhere, right? I mean, or who knows? I mean, God knows.
No.
Something will change in 5 years. But the point is, it's here. It's a viable industry. There's winners, losers, high valuations, but it's not Pets.com at
Right, it's not
$5
IPO
billion.
Right, and it's not IPO driven. It's driven by, for the most part, smart venture capitalists that are seeding these companies.
Yeah.
You haven't seen a lot of offerings so far, and so they're continuing to do it. I think a lot of these guys are making money. Some of these guys are making money. So
It's the diversity of our economy. I mean, New York has, and there's other things like we don't talk about. You know, what's the biggest driver? Healthcare.
I was just
I
going to
mean,
say
that's a
it was
massive-
coming out of my.
And we're a
Education
college
is-
town.
College, exactly.
My gosh, look at
Education.
us. We're a university
Look,
city.
I mean, if you look at the amount of space that, and I'm going to write an article, Verizon sells all the space, NYU buys most of the space, and it's becoming healthcare. And look what's going to happen in Roosevelt Island. And
We're
all
calling it
rest.
the EdMed complex.
There's no question.
It's diversity.
When we start the 12th season, I know that I'll have all of you back, and I want to thank you today for being here. I'd like to thank Gino Martocci, Mark Boissy, Joe Harbert, and Winston Fisher. See you next week.